message to keep across today. Big day, but just following on from what Michael said in regards to the US and the shutdown of the government, look, implications in your opinion for markets?
Well, I guess if we have a look at the issues facing the market from the US economy, I think you can group it into two separate areas. One is the US shutdown and the other is the US debt ceiling. In terms of the US shutdown, it really depends on the length of the US shutdown, on how big the impact on the US economy is going to be. And if we have a look at some of the estimates in the market at the moment, Goldman Sachs estimating a 0.9% of the fourth quarter GDP numbers at an annualized rate. If we do see a two-week shutdown, Moody's predicting around about 1.4%. We have a look at macroeconomic advisors. They're saying that without the shutdown, it would have been about 2.5% annualized growth in the last quarter of the year. With the shutdown, they're predicting 2.3%, and that's on a two-week shutdown basis. So really, it is dependent on the shutdown. If we have a look at what this shutdown entails, there's about 2.1 million civilian federal employees, and about 35% of them are said to be affected, so about 800,000 employees. And of course, if you have 800,000 employees showing up without a paycheck in the current month, then that's going to have an impact on spending. So we are watching retail spending. The numbers have been rather anemic, but they have been showing growth. In August, we saw growth of 0.3%. In July, we saw growth of about 0.2%. If the shutdown continues on for a number of months, then that's going to have an extra impact, and that will have an extra impact in terms of support programs as well as entitlements, so a bigger impact in terms of growth. But I guess the worst impact could be if we start to see foreign creditors exiting, and that would have a major impact in terms of the US dollar, and we would see a significant weakening off in the US currency, and we could hear talks of haircuts to US debt, and that's a worst case scenario there. But for the time being, the actual shutdowns, it is temporary. Markets not really reacting too much to it. I think the bigger issue for markets are the debt ceiling negotiations.
To have to seriously consider and position ahead of the debt ceiling?
And that's the key issue for markets at the moment. I think we need to separate what's happening in terms of the US into two separate things. One is the partial shutdown that we are seeing, and secondly is the issue of the debt ceiling. Now, if we have a look at the issue of the shutdown, well, the last time we saw a shutdown was at the end of 1995 and the beginning of 1996, where the US government shut down for 3 weeks. And we can have a look at how the markets reacted back then. We saw gold did quite well out of the shutdown. We actually saw gold prices jumping, but everything else was just a temporary effect. In fact, if we have a look at the S&P 500, and if I can bring up a chart of the S&P 500 back in 1995, 1996, and I'll just show you what the market looked like back then. So this is December. Through the shutdown, we saw a mild impact in terms of the market, and you can see that after the shutdown, the markets just returned back to normal. It was the same thing in terms of the currency markets. We saw the US dollar initially strengthening, but very much a V-shaped recovery if you're having a look at the Aussie dollar to US dollar chart, and then very quickly just weakening off once again. It's a whole separate issue, though, when we're looking at the US debt ceiling. Now, the last time this became an issue was in August 2011, and we saw a massive impact on markets. So unlike the shutdown, which was a temporary, very short-lived impact on markets, the issue of the debt ceiling is a very serious one for markets. In fact, if we go back to August 2011 and now look at the S&P 500 index, this is the S&P 500 index, and I'll just zoom in on the markets at that point in time. And if we have a look at August 2011, you can see exactly what the impact on markets was. We saw the S&P 500 actually decreasing by a massive 19%. We saw Standard & Poor's coming out to downgrade US debt from its AAA status, and we saw gold prices reaching its all-time record high price of $1,923 US an ounce. So I think two separate issues right now. The market's dealing with the shutdown, and that's not having a huge impact in terms of markets. What we're looking at is an impact in terms of GDP in the current quarter, but the debt ceiling is a whole issue altogether, and if we don't see that debt ceiling being raised, that's going to cause a huge disruption in terms of markets.
Julia, how do you see equities trading ahead of the debt ceiling deadline then?
Well, we've been seeing a little bit of nervousness in the markets at the moment, but really we've seen very low stock activity. I mean, today on the market we saw less than $3 billion being traded. So while there's a high level of macro activity, there's very little stock activity, and investors have gotten used to this volatility in the past, and what we have seen is a move into safe haven assets, and whether that's treasuries or whether that's the bonds, fixed interest, or whether that's plain cash. Investors have been through a lot of turmoil in the last 5 or 6 years. So it is going to be those defensive strategies which do reign when there is potentially disrupting events like the debt ceiling negotiations going on. I mean, today, massive amount of macro news coming to the market, but extremely low level of stock activity. I mean, today we saw in chronological order, we saw the China official PMI numbers coming out at 11 a.m. on our market. They were lower than expected. Retail sales in Australia coming out at 0.4% for the month of August. Then at 2 p.m. we saw the US shutdown. 2:30 today we saw the RBA rates decision, and to add into the mix, Japan as well. Prime Minister Abe, he'd been brought in with a mandate to grow the economy and to fight to try and get inflation into the economy, and he's now raised the consumption tax over there from 5% to 9% as of the 1st of April, so putting a rubber stamp on that one. So a huge amount of news, but in terms of the market, really not too much happening, less than $3 billion worth of stock going through, so investors just sidelined ahead of some big events in terms of the US.